Hey everybody, Marty Missouri. Good afternoon, August 4th, 2016. This will be your only video this week. Been away from the office about a week, so I think the last one of these I did for you was for last Tuesday, and there's lots to talk about. I've been thinking about the perceived correlation between oil and stocks and sentiment and the volatility index and lots of things that we could talk about, but if I hit it all, I would take more of your time than I deserve. So today I thought I'd do a couple of things. Number one, just briefly talk about tomorrow's jobs number. Unlike last month where the indicators leading to it, to me, were pointing to the likelihood of a noticeable beat of expectations. This month, those same indicators are pretty much pointing to what I think is going to be a number that's going to be pretty close. I think the consensus is around 170 or 180,000 jobs. I think if we hit that number, there won't be any great event or market event. If it's very high like it was last month, that could move the market in either direction based on prospects for a better economy, but countered by prospects for a more aggressive Fed. If it comes in way under estimates, the market could go either way. It could be fear over a weakening economy, countered by the prospects for a less aggressive Fed. So it could be down or up, given those two potential reactions. So that'll be interesting to see. Of course, I'll have commentary probably over the weekend to kind of help you put it in perspective. For today, I want to go back to the whole sentiment discussion, and I'm going to start with showing you a video where the reporter comments on or reads to you the commentary in a telephone call with very popular money manager Jeffrey Gundlach. Mr. Gundlach is very negative on stocks, and he says sell everything, sell the kitchen sink, and he's very positive on gold. So take a listen.
Jeffrey Gundlach says sell everything. The chief executive of DoubleLine Capital said on Friday many asset classes look superficial while his firm continues to hold gold. In a phone interview with Reuters, Gundlach says he feels investors have entered a world of complacency while economic growth stays weak and corporate earnings remain stagnant. Gundlach feels the stock markets should be down a lot, but investors seem to be convinced nothing can go wrong. The bottom line, Gundlach tells investors to sell everything.
So I find Mr. Gundlach's commentary that investors seem to believe that nothing can go wrong and that there's just this incredible complacency very inconsistent with what I'm seeing in the sentiment indicators. What you see in front of you, the white line, is the bullishness reading for the American Association of Individual Investors weekly reading. The 29.79 is where we sit this week. And this is probably the most watched sentiment indicator of all. And as you can see, I've drawn a trend line from where we were back in late last year, which was above the average. That's the red line. That's the long-term average, 38.5% bullishness. And you notice that for the most part, it's been trending lower, and it's really come barreling down here of late. And Mr. Gundlach made those comments really right in here. So not sure who he's talking about or what he's looking at. I also have referenced of late the general bearishness of mutual fund managers in the most recent survey. I do know that Mr. Gundlach is very heavy in gold right now and thinks that that is a good place to be. Now, in terms of sentiment among professional speculators, what you're looking at here is from the report from the Futures Trading Commission, and this is called the COT, or the Commitment of Traders Report. The green line is the net non-commercial, so these are pure speculators, futures positions in gold. And as you can see, it's positive, substantially positive above the zero line, which is that bold white line there. And it has been all year. In fact, it's been mostly growing, just kind of maybe turned over a little bit of late. While S&P 500 stock index futures just turned positive in late April, then went negative again, positive in May, then negative again in June, and is now positive above the zero line a bit. But when Mr. Gundlach is talking so optimistically about gold and kind of suggesting that equity traders or equity investors, mutual fund or stock investors, are living in some sort of bubblicious la-la land of optimism just does not square with the data that I've shown you so far in terms of individual investors, in terms of mutual fund managers, and now even in terms of futures traders. So I'm not sure who he's tracking or what investors he's talking about. It appears that he's really just talking about where the level of the market currently is at new all-time highs, but we're talking about a level that hasn't been reached in over a year. And we're talking about a level that is just above a very tight range for the last 2 years. So an upside breakout, then finding new support amid what I think is on balance relative pessimism, is not so far-fetched despite valuations and so forth. So of course I make no guarantees, but I just don't buy the argument that several people are proposing, that stocks are just ready for some massive fall. I know for sure their portfolios are positioned that way, so this is very much wishful thinking. And again, people like Gundlach have got good track records and are very smart individuals. But when you dig under the surface and you really check what they're saying, yeah, you got to wonder if maybe they're just not screaming their portfolio positioning more than they're truly looking at what's going on under the surface. Now, as you know, markets can be very volatile. We can be surprised, and he may turn out to be right. But he's definitely not right now in terms of his commentary about where investors are, what they're thinking, where they're feeling, and just this profound complacency and, if not over optimism that he refers to. And then lastly, folks, just taking a quick look at the one-year daily chart. As you can see, the S&P 500 has maintained itself above the purple line, which is the last May all-time high. Generally speaking, I kind of like this sideways move, or I think bulls should like it because it appears to be some consolidation. You can see we did see a pretty sizable drop, at least on an intraday basis, on the 2nd, and then bounced off of support, and then came down, tested that support again, and then kind of did it again today. So those are good signs. Now, I will be very surprised if the S&P does not come back and at least test this 2132, which was the May all-time high. One would expect that there would be support there. And think in terms of it this way. And this is kind of how these support and resistance lines work, or at least this is how they should be viewed. So you have the Brexit happened. It was unexpected. There were a lot of people fearing the market at that time, as I pointed out numerous times of late, that literally had to come back in the market because suddenly they feared losing out. And then we shot to all-time highs. No doubt there's a large number of traders who missed this move because there was a great deal of skepticism about it. So you make it through there, fairly substantially, you consolidate a bit, and you have these investors or traders up here who wish they would have bought in. So as we come back down and they know how these things work, what you might expect, and would not surprise me at all, is to find support right there as they take the opportunity to get in at a level where they missed before. Okay. If that doesn't hold, and if we don't break down there, then we've got a very firm 2100 on the S&P, and that, as you can see, and I can move this back, has been like a magnet to the market for quite some time. In fact, if you go back all the way past last May, where the market hit that all-time high, you can see how it just kind of danced with 2100, almost touched it there. Came out, resisted it a little bit, got above it, found a little support, then came breaking back down, came back up, resisted it, came back down, came back up, resisted it, supported it, and so on and so forth. And so you can see as the market for quite some time, well over a year, in terms of the S&P 500 has moved around, that 2100 line has been a very interesting, and I'll say it again, magnet for the market. As we get below it, it seems to pull it back up, and then we get above it, it seems to pull it back down. So I have to believe with such long-term support and resistance, a lot of it has been resistance, that could very well be a very important support level for folks who are technical-oriented traders, in terms of particularly the ones who missed out in terms of an opportunity to get back in. Now, we could break down way below that. I've been talking all year about the prospects for that. Some of the technical indicators, which I'll update for you in the coming days and weeks, are beginning to show some signs of weakness again. I have here, though, a pretty good look in terms of the 50-day moving average and the 200-day moving average. The slope is going in the right direction, and the space is going in the right direction. That doesn't mean these things can't turn and move in another direction. We've got lots going on between now and the end of the year that could really upset the markets. Not the least of which being the simple seasonality. And I know a lot of people are looking at this and talking about this, and maybe this explains the positioning of folks like Mr. Gundlach. So the heat map that you're looking at, folks, the top line is the 5-year trailing high month by month. The next line is the average for the last 5 years, and then we have the low by month for the last 5 years. Then you have what's happening so far in 2016. So as you can see, August on average has been the worst month of the year for the last 5 years, and you can see September hasn't been a whole lot better. So no doubt folks are looking at this. Certainly positioning is going on here in anticipation of this, and this is potentially another headwind, but it also leads to what I believe is this overall lack of bullishness, and that's a good thing. So for the time being, I think that the fundamentals are relatively okay. I like the fact that sentiment, as I keep stressing, is pretty bearish. Earnings season so far looks good in terms of earnings beat, looks okay in terms of revenue beats, and outlooks look okay. So I'm not really feeling that uncomfortable with the stock market today in such a low interest rate environment. But of course, there's lots more to come as the days and weeks unfold, and I'll be here to give you my updates on it. Thanks, folks, as always, for watching and listening, and look for the weekend update in the next day or so. Bye-bye.